Hey everyone, and welcome back to the channel. Today, we're re-diving into a topic that feels more relevant than ever. What can we learn from past financial crises? It might sound a bit heavy, but trust me, understanding history is one of the best ways to protect ourselves and even thrive, no matter what the economy throws at us. From the Great Depression to the dot-com bubble to the 2008 meltdown. Every crisis, while unique, has left behind a trail of clues and powerful lessons. And these aren't just for Wall Street bigwigs. They're for all of us. So grab a coffee, get comfortable, and let's unpack the timeless wisdom hidden in the chaos of financial history. Let's start with the big one, the Great Depression of the 1930s. What's the number one lesson from that era? Diversification and the danger of putting all your eggs in one basket. Back then, it was common for people to have all their money in a single stock or a single bank. When the stock market crashed and banks started failing, people lost everything overnight. It was a brutal lesson in risk. This teaches us the fundamental importance of spreading our investments across different asset classes like stocks, bonds, real estate, and maybe even some alternatives. It's not about avoiding losses altogether, because that's impossible. It's about ensuring that a blow to one part of your portfolio doesn't wipe you out completely. It's the financial equivalent of not building your house on a single pillar. Jumping forward a few decades to the 1970s, we had the stagflation crisis. This was a strange beast. High inflation and high unemployment at the same time, something economists previously thought was impossible. The key takeaway here, understand the real return on your money. During periods of high inflation, the cash you have sitting in a low-interest savings account is actually losing value every single day. Its purchasing power is shrinking. The lesson from the 70s is that you have to invest in assets that can outpace inflation. This could be stocks of strong companies that can pass on rising costs to consumers, or real estate, which tends to rise with inflation over the long term. Just holding cash can be one of the riskiest things to do when prices are soaring. Now, let's talk about the dot-com bubble of the late 90s and early 2000s. I'm sure many of you remember this. The internet was new and exciting, and any company with a .com in its name saw its stock price skyrocket, often without any real profits or even a solid business plan. People were caught in a frenzy, a classic case of what we call FOMO, fear of missing out. The lesson here is crystal clear. Don't get swept up in hype. Always do your own research and understand the fundamental value of what you're investing in. Ask the tough questions. Does this company actually make money? Does it have a sustainable competitive advantage? Or is its price just being driven up by pure speculation? The dot-com bust showed us that hype eventually fades and only real value endures. Gravity always wins in the end. That brings us to the most recent major global event before the pandemic, the 2008 global financial crisis. This was a complex crisis rooted in the housing market, but the lesson for the average person is profoundly simple: beware of too much debt. In the years leading up to 2008, it was incredibly easy to get a loan. People were taking on mortgages they couldn't truly afford, fueled by the belief that house prices would only go up. But when the bubble burst, millions found themselves underwater, owing more on their mortgage than their house was worth, leading to a wave of foreclosures. This teaches us to be cautious with leverage. Debt can be a powerful tool to build wealth, but it's also a double-edged sword that can amplify losses and lead to financial ruin. Living below your means and maintaining a healthy debt-to-income ratio isn't just good advice. It's a critical defense mechanism. So, we've looked at a few major crises, but what are the universal threads that connect them all? I think there are three big ones. First, human psychology never changes. Greed and fear have driven markets for centuries and will continue to do so. When everyone is greedy, be fearful. When everyone is fearful, it might be time to get a little greedy, or at least to look for opportunities. As the famous investor Warren Buffett says, be fearful when others are greedy, and greedy when others are fearful. This contrarian thinking is a hallmark of successful long-term investors. It's about keeping a level head when everyone else is losing theirs. The second universal lesson is the incredible importance of having an emergency fund. In every single crisis, people lose their jobs unexpectedly. The economy tightens and income becomes insecure. Having a stash of cash, typically 3 to 6 months' worth of living expenses, is not just a suggestion. It's your financial lifeboat. It's what allows you to weather the storm without having to sell your investments at the worst possible time or go into high-interest debt just to pay your bills. It provides peace of mind and, more importantly, it gives you options and staying power when things get tough. An emergency fund is the foundation upon which all sound financial planning is built. And the third and perhaps most optimistic lesson is this: the market always recovers. Always. Look at any long-term chart of the stock market. You'll see the crashes 1929, 1987, 2000, 2008, 2020. They look like terrifying cliffs. But if you zoom out, they become small blips on a powerful upward trending line. This doesn't mean it isn't painful in the moment, but it teaches us the power of a long-term perspective. The key is not to panic and sell at the bottom. If you are invested in a diversified portfolio of quality assets, history has shown that the best course of action is often to stay the course, continue investing if you can, and trust in the long-term growth of the global economy. Time in the market is far more important than trying to time the market. So, to wrap it all up, diversify your assets. Be wary of inflation, ignore the hype, and focus on value. Be cautious with debt, and always keep a level head. Build that emergency fund as your personal safety net and maintain a long-term perspective, trusting that economies and markets are resilient. By learning these lessons from the past, we can navigate the future with more confidence and wisdom. We can't predict the next crisis, but we can absolutely prepare for it. History doesn't repeat itself, but it often rhymes, and being a student of that history is our best defense. Thank you so much for watching today. I hope you found this breakdown helpful and empowering. If you did, please give this video a thumbs up, and don't forget to subscribe to the channel for more content on building financial resilience. ID. Love to hear your thoughts in the comments below. What is the biggest financial lesson you've ever learned? Stay safe, stay invested, and I'll see you in the next video.